Sorry. So I hope you can see my screen now, everyone.
Yes, sir. Good
Yes,
evening.
sir.
Okay, great. Okay, so the last class that we were at, that was about derivative, right? So the last session that we conducted was about derivative forward. So we will start where we left. And before that, probably if you have any questions, anything which you want to discuss, want to talk about, you're most welcome to raise your thoughts, concerns, anything for that matter. One second, just give me a second. So everyone is there. Anyone who was supposed to join did not join. So we have Altamash, we have Anurag, Apur, Rishika, Mayank, and Sudiksha. We Abhinav is there. Okay. What about others? Bhavya is there.
Good morning, sir. I've just joined right now.
Okay, Siddharth is there. Okay, fine, Siddharth. Okay, so what and who are missing? I guess Vishal is missing, right? And Harshit is not there. Then Prakhar is not there. Sumit is also not there. Okay, and Vaibhav is not there. Okay, so probably we can start now, and if others join, fine. Otherwise, we will move on from here, right? So, guys, we were doing derivatives in the previous class, right? So, we had covered couple of slides already. So, I'll just take you through quickly to those slides that we did in the last session, and then we will come to the last, as in the slide where we left it. So at this, I hope you all can see my screen now. Okay, everyone.
Yes, sir.
Okay. So if you look at this slide here, right, what this slide actually tells you about? This tells about this is telling you about the derivative market, how huge the derivative market is, right? So if this gives you the size of the world GDP, that is $78 trillion, right? And this gives you how strong or how big your stock and bond market is. So it is $100 trillion. And when you look at the financial global derivative market, so it is $700 trillion. That's a huge, huge market. So derivative undoubtedly is a very, very huge and big market, and that's the reason when you go back and look at the 2008 crisis, so that's the reason the impact was huge. Though it was not the uh, it is not the everything in a derivative market was bad. It is only certain instruments which were traded in a in not a great in traded in a negative way, were not traded in a right spirit. So that's the reason it all took in a bad in a wrong direction, right? So this is just to give you a glimpse of how big the derivative market is. Okay, moving on. Let me know whenever you have a question. If I am just moving and you have any thought or question, do let me know. You can tell me, or you can chat your thoughts in the chat box also. Okay. Okay, so this is again we covered in the last session, wherein the Warren Buffett said derivative are mass destruction instruments. So so this is a thought of a Warren Buffett, right? So he doesn't like derivative much. His understanding around derivative is that these are very destructive instruments which can lead to huge destruction also at times, and which happened in 2008, we know, especially if you look at products like CDS, that is credit default swap. So these are really very, very uh, good products, and at the same time can turn out to be very bad product if they are misused, especially in times of volatility or in times of difficult situations. If these products are misused, then it really can cause a lot of destruction to the entire financial market, as we know, right? Okay, so risk is constant companion for all the participants of financial market. We know when you are dealing in the financial market, be it derivative, be it stock or bond market, the risk is something which is inherent in it. We cannot go without risk. And so there are two kind of people. One is rather three kind of people in the financial market. One is a hedger, another is speculator, and another is the arbitrager. So they have got their own reasons of doing trading and be part of the financial market, right? So derivatives were introduced initially to mitigate this risk, to hedge. Subsequently, the scope of speculation increased with derivative. So the idea of derivative initially was to give in a space or given a platform wherein people can mitigate the risk. But as you know, whenever there is a market established, so there are people who come with a vested interest, or with the interest of making profit, with the interest of making profit in the trades they do in the financial space, right? So therefore, now we also have speculators in the financial domain. Okay, so this is one of the contract that we discussed in the last session also. Derivatives are financial contract whose values are derived from the values of underlying assets. So underlying asset can be anything, right? So it can be a financial product, it can be a commodity also, it can be anything for that matter. The trade can also be done on uh, on products, or on things like weather, climate. All these things can also be the underlying in case of a derivative contract. So when you talk about derivative is just a mere contract between two parties, nothing else, nothing more, nothing less, right? So but where it is deriving its value from, it is deriving its value from the underlying product. So whatever underlying you're making, that would be actually driving the value of the derivative instrument that you have at your hand. So in this particular situation, it has been shown rice is one of the product or the commodity which buyer wants to buy from the seller, and the seller is ready agreeing with the quote or the rate, and it is a predetermined rate for a predetermined period. So these terms are decided in the beginning itself, and with these terms, the deal will take place at the end of the maturity or at the end of the expiry. So that is how we are terming it. It is just a mere contract. So if you look at in the beginning, we are signing a contract and we are not actually settling the contract. So when you talk about settling a contract, that means you need to pay the complete value of the trade that you are taking, and or the other party has to take the delivery of the product which is being signed off in the initial stage. So that is not taking place in the beginning, so that takes place at the end. So the contract in case of future, it can vary from 1, 2 or 3 months. So there are three maturity available for it for an investor or for the trader who is getting into trade for futures contract, right? We know this can be 1 month, it can be 2 months, it can be 3 months. So I can go for a 3 month contract also. In the beginning, I can go for a 1 month contract also. I can go for a 3 month contract. So what is being done here? Why a person is doing this contract? So there could be two reasons for that. One is, what those reasons could be, if anyone would like to elaborate, because I assume you know that. Anyone has any understanding why this contract is being done here? Yeah, anyone?
So because
Abhinav?
in future,
Oh yeah,
hello,
Ishika, go ahead. Yeah, go ahead.
because in future the both the parties don't deny that there is any contract. It can be a proof for the agreement which the both the
Hmm.
parties made
Right,
for
right,
exchanging the product.
right. So yeah, so there should be some legal instrument available so that in case of any dispute, that that particular instrument can be referred, and accordingly the legal dispute accordingly dispute can be settled down, right? So that is the reason why you need to sign a legal instrument in the beginning, right? And why the buyer is taking that in, apart from the signing of the instrument which is being taking place when this agreement is being written, what is the other reason for a buyer to take position in this trade? What are the other reason why the buyer is taking position or taking this trade in the first place?
So
Yeah.
because buyer can think in future the price of the security can be boom and it will beneficial for him. So they
Hmm.
can make a contract in advance that the security which he purchasing today at a same price of at the current market price will be beneficial for him. So it will be more advantage for the buyer to settle the
Hmm.
price of settle the contract at today's price.
Absolutely. Anyone else? So when you have a buyer who believes the price of a security or price of the particular commodity will rise in future, and with this intent the buyer takes a position in a trade, so what would you call, or how would you term that buyer? What name or what tag you would associate with that buyer? So any clue? Yeah, apart from Ishika, anyone else? Yeah, Apur, what are your thoughts?
Sir, he may be a hedger.
Yeah, right, right. So, so in this situation, when an individual is got a view, the price of a security would rise in another few months or so, and with that intent, the individual is taking a position. So that person would be called a hedger or something else. So, as per your
So
understanding,
I
it
think
it would be called hedger.
So
Who said
speculate.
speculator? Shika,
Kushika.
okay. Okay. And what about others?
Speculator, sir.
Yeah, Siddharth says speculator. Okay. What, Harshit, what's your view? Harshit you joined just now? Harshit is there?
Yes, sir.
Okay. So Harshit, I'm having a discussion with you and just asking this
Mm.
question. This you can see my slide. You can see my slide, right? As in the presentation that I'm sharing with you.
Yes, sir.
Okay. So the question is, there is a person who's taking a derivative contract. So this contract is there before you, wherein he is agreeing to buy rice at a rate of 120 per kilo, right? And in a period of 1 month or so.
Yes,
So
sir.
right, so this person, would it be called a hedger or a speculator? If the individual just thinks the price of the commodity will rise, and with this intent, the individual is going and taking a position. So will that person would be called a hedger, speculator, or arbitrager? What are your thoughts?
So, according to me, sir, he's a speculator because uh, yes, he's a
Hmm.
speculator, sir.
Right. So guys, we need to be very clear with these terms, right? So whoever said speculator, that's right. So when a person is not hedging a position, right? Or when a person is not utilizing that contract for something, some other reason, so that person would not be termed as a hedger. So how would you say an individual is a hedger when this position is being taken? How that hedger situation can be created? Can you create a hedger situation out of this example? Who can do that? Any idea? Any clue? So let's put it this way: there is a buyer, there is a seller, and a buyer runs a bread factory, or for that matter, maybe a factory where the rice is needed constantly, right? Right. So where he requires rice on a constant basis, month on month, year on year, right? So now the buyer knows the stock which they have got with them, it is going to be empty over a period of 3 months. And with this intent, the buyer is taking a position in this contract and getting this deal done with the seller, right? So in this situation, would this person would be called a hedger, or would he be called a speculator? What are your thoughts? Abhinav?
I think hedger.
Okay, Mayank, you said? Who said?
Bhavya.
Okay, Bhavya, yes. Hedger, okay. Abhinav, what are your thoughts? Hedger, right. So remember these terms. So you need to be very clear, like when a person would be termed as a hedger, when the person would be termed as a speculator, and when the person would be termed as an arbitrager. Any idea when an individual is termed as an arbitrager? I guess we discussed this in the last session.
Okay.
Who is called
So
an arbitrager? Yeah. Who knows about arbitrager? What are arbitrager? Who are arbitrager? Any clue?
Sir, uh,
Yeah.
yeah. When the buyer purchases derivatives at lower price and waiting for the rise in its price, and after that he sells to other
Hmm.
then it
Another market.
in other market. Then
Hmm. Right. Right. So, so I hope now everyone is clear with the idea of hedger, speculator,
Can
and
you please
arbitrager.
repeat?
You right?
Can you please repeat arbitrage, sir, once?
Yeah, so arbitrager are the individual who take advantage of two different markets, right? So two different market wherein there is a this slight price difference, right? So you buy
मार
from
दूंगा, मैं
spot
मार दूंगा.
market. So just to give you an example, you buy from a spot market. Spot market
Okay.
is a normal cash market, right? The equity market, and you sell the same product in the futures market. So these are two different markets. You can say future market is a different market, and a cash
मार
market is a different market. So you buy a product from the futures from the cash market and sell the same thing in the futures market. So there is a price difference that you would be finding in the futures market, and therefore you are leveraging these two markets. So that individual is would be termed as arbitrager. Clear?
Yes, sir.
Similarly, there are
Sir,
arbitraging can also happen.
who
Yeah,
makes the profit from the both market, na?
yes,
That is advertiser. Okay.
yeah. So the person who's making profit from
Both the
one
markets.
market, yeah, yeah. So you can say the person is making profit by doing trade from one market to another market. That way we can say the person is making profit from these two markets. So I am buying from the cash market and selling it in the futures market. That's the one example of arbitraging, which arbitragers do. And another example could be wherein you're buying from one market, that is NSC as a market, and selling the product on BSC. You can buy a product from the NSC and you can sell the product on BSC also. So, and that can be done when you see a price difference. When you see a price difference in BSC, that point in time you sell it. So that difference is usually for a very short span of time. That difference would not be for a huge time. Why? Because as the market phenomena goes, the supply and demand is something which is running the market, as we know, right? Supply and demand is the thing which is running the market. So when people see this opportunity of arbitraging wherein they can buy from a one market like NSE and sell it in the BSE market with the price difference, and with that they can make a profit. So the supply side, so when this phenomena or this thing happens, so everyone would start selling, right? Everyone will start selling, so the sell side will increase, and therefore the price difference which is available in a different market will be narrowed down and will be filled very very soon, and this arbitrage opportunity will be lost, right? So this is there are two things to it. One is the two different markets, and there could be two different venues also, right? So one is from NSC going to BSC, so that is also arbitraging. Any questions, any thought? We should be very clear what hedgers do, what speculators do, what arbitragers do, right?
हाँ हो गई रोटी. अच्छा.
Guys, please mute yourself. Your background noise would be uh, unless you want everyone to hear your background voice. Okay, so let's move on. The underlying of a derivative is an asset, basket of assets, index, or even another derivative, such that the cash flow of the derivative depend upon the value of this derivative, right? So these are the non-financial derivative that we are saying, wherein it can be commodity, weather, etc., right? So all these would be termed as non-financial instruments, and here we have got equities, bonds. So these are bracketed in the financial instruments. So the underlying can be anything. It can be non-financial instrument, it can be financial instrument. When you look at derivative means any instrument, anything for that matter, be it a financial instrument, be it your non-financial instrument. Derivative can be made out of anything. Derivative is the use of speculating, hedging risk associated with the fluctuating price of assets. So this is a hedger, and here we have got speculator, right? I think the price of a rise will go down in the future, and I will make a loss if I hold on to the asset, right? And I think the price of rice will go up in the future and I will make a profit. So speculator derivatives can be used to hedge if a market moves exactly opposite exactly opposite to their expectation. Derivative can be used by participants to speculate and make profit if the market moves as expected by them, right? This is the same thing that we have discussed. If a commodity cost rupees 100, should the price be same in the same quantity were to be traded today and but delivered by the seller after 3 months? If the price has to be different from the spot price, how would the price be determined? So how do we determine the price of the future contracts? What is the calculation that is done while we actually determine? So we know we determine our basis couple of things. One is your risk-free interest rate, cost of having or storing the commodity, right? So pricing, futures pricing, you can say future pricing. So how that is done? It is done risk-free interest plus your storage cost in case of commodity, right? And then you can also say the interest, oh sorry, your margins. So primarily these two things are there. So your these two things are there primarily, unless there is some other cost involved. Maybe if in case of stock, there if there is a dividend and all, right? So dividend payment is there, so that would require to be filtered down, right? So this is how you would be calculating your price of future contracts. So the risk-free interest rate, because when you're buying something, you would always factor in the what interest rate you can earn from the market. So that has to be shown in the price of the spot price of the product that you're buying. So you're buying a future, so that would be reflected in the future contract. Similarly, if it is a commodity or something, then there would be cost applicable to store the product. So that would be their storage cost. And if you are looking it from the point of view stock, so there is a dividend payment. If the dividend payment is coming in another 3 months or 2 months or 1 month for that matter, so that would also be reflected in the pricing also, right? So these are the factors which actually lead to the pricing of a future contract. So if you look at here, so price of future would be different than the spot price. So if spot price is whatever the spot price is there, so the future price would be higher than the spot price. Right? Agreed, everyone? Any question around it?
So, from where we take the risk interest rate? It's come from the market, or
So yes, yeah. So you would be taking it from the market only. So what is when you look at the risk-free interest rate, that means basically the interest that you can earn without any risk, right? That is how we say it, risk-free interest rate. So whatever rate is available in the market as a risk-free interest rate, that means what the bank can give you when you keep your money in the bank account, maybe 4%, 5%, that would be termed as risk-free interest rate. So if your bank can offer you 6% interest rate without even having your money blocked there, so that is your risk-free interest rate, right? So that is how the pricing is being done. Are derivatives traded in shares and bonds? Yes, derivatives. Yeah. So these are the no, no, no. It is everything. Derivative can be anything. It can be your shares. It can be for bonds also. It can be for commodity also. Everything can be there in derivative. Everything, even something which you can't think of, that can also become a derivative. So that is how this derivative is. So derivative has there's a that's a good thing about derivative. It's a beauty of derivative that the derivative is a contract which can be made on anything and everything, right? So let's move on and see few more things, then you would be having more clarity about derivatives. So the buyer wants to trade today, agree on the price, but would like to pay at later date. A seller would like to agree and lock the price, but deliver the commodity later date, right? So this is the feature of a derivative, we know. So there is an agreed price, there is an agreed date, and there is a agreed quantity. So all these things are predetermined while the contract is signed, and everything takes place or delivered when the contract is due for delivery or due for settlement. So that is one of the brilliant feature which a derivative has. So you would not have to shell out the entire money in case you want to buy a stock or a bond from the market. You will have to you will have to shell out the complete money associated with that trade. But in case of derivative, you would not have to shell out the entire money. Rather, you would be just giving part of or some percentage of the entire value of the trade, and the rest of the money would be settled when the trade is actually due for settlement. So that is something very good about derivative. In such a scenario, what should the price of contract? Since the seller would be incurring additional cost for storing the cost until delivery, would also be losing opportunity of using the consideration if he will have to compensate it for this and making the buyer pay the additional amount. So the pricing we have already discussed. Whenever there is a commodity which is being traded in derivatives, so there would be a storage cost associated with that. So that is also featured when the pricing is being done for a derivative, right? So apart from the market variation that may come uh, with the time ahead, there would be some variation in the price, and depending upon the supply and demand in the in the current time, and what would be the demand and supply in future, that would lead to the future price. And but if you look at the today's future price, it would be coming is being driven with the current demand and supply plus your this thing, the storage cost and all. So these things will be driving the price of the derivative. So the features, when you look at the features of derivative is contract is stated, not the underlying asset, right? No ownership right associated with the asset sold. Derivative contract is priced separately from the asset without putting up full cash value that we discussed. You do not need to put your complete contract value. It is just the some percentage of the contract value that would be put in the first place when the contract is being signed, and later on when this contract is on, so the margin amount would be shared. I would be discussing about margin at the later at the later at the end, rather I would say. There are a couple of slides about the margin, how the margin calculation is done, everything is there. So we would also be looking at the margin thing and try to understand how margin works in the derivative space. Derivative contract can be delivery based or cash settled. So you remember we discussed one of the example last time, wherein we took an example of one of the share stock, right? And we were taking a uh, future derivative. So there we were making one. Let's take an example. So maybe you take in a TCS. TCS share is around 2100 something, right? So I, as a investor or a trader, buy TCS share, or rather lot, I would say, future, buy TCS futures contract. Okay. And what is the contract size? What is the lot size for future? Any for TCS? Any idea? Anyone? At the moment, because this lot size can also change if the price goes down. Lot size can also vary. So it is not the lot size will remain same constant. Lot size is also changes subject to the change in the price. So the current lot is, one second. Hmm, I can see it is your 300. So when I say one lot is equal to 300 shares, right? So you cannot buy one share when you deal in future. You have to buy a trade in lot. So when I say one lot consists of 300 shares. So what would be the total value? Total value is equal to this multiply by 300. So that's the total value. Okay. And now, given you've taken a 1 month future, okay, 1 month future. So now the value of future contract may vary over the period, but you are not affected by that. Why? Because you have already taken a contract and now the seller is obligated to fulfill this contract. And the strike is you bought it at 2100 rupees. So 2100 multiplied by 300. So this is the price that you would be paying for this future contract, right? So you are not, so there could be a price of 21 or 2090
Sys-
the next day it could be 2090 also, assuming 20, this is 28, and you have bought it, assuming that you have bought this contract on 27th, that's Friday, right? 27th was Friday, 7th November. Okay.
Sir, strike as in, what does that mean, strike?
Okay, so the strike is basically is the price on which you are buying the contract. There should be some, so this strike is basically called the price at which you are purchasing your contract. So that is called
Okay, sir.
the strike price or exercise price, you can say. The two terms which are used for the same thing, one is a strike price or exercise, one are the same thing. So strike is basically the price at which you are buying the lot. So if you look at this particular contract, we are buying the future contract for TCS, right? And the one lot consists of 300 shares, and the total value that comes out to be is 2100 is the, I assume I am buying at a strike of 2100. I'm just taking an example. I'm not sure the current price of TCS. It may be higher also. And so so 2100 is a strike price on which you are buying the future. Okay. And what are the total shares available in one lot? It is 300, right? So what's the total value? It is 63 and 6300, 63, sorry, 6 lakh 30,000, right? So that's the value. Now, the important thing is the the strike price that you bought it on Friday, that is on 27th, is not necessarily remain, not necessarily to be remain same over the period. It will keep changing with the supply and demand in the spot market. So maybe on 30th November, which is Monday, right? The demand and supply swings and the spot price is is going coming down. So the future price will also vary. So because future price is being coming from the spot price only. So I assume the future price is this at the close at the day, and closing price would be 2090. So you are not affected by this price. Why? Because you have already struck a deal at this rate. So your your trade is locked. You're not going to be, this trade is not going to be changed unless you yourself want to square off your trade. You can leave the product, or you can sell the product the next day also, depending upon the opportunity available to you. So at this moment, the, this deal can be scored, can be offloaded at this rate, that is 2090. So you would be incurring loss if you square off at this rate. Clear? Maybe on 1st December, the rate is right 2110. So are you incurring profit or loss this time? The strike price is this. Oh, as in the rate which is available in futures market is this.
Profit, sir.
Profit, right? Okay, so Siddharth is asking, how can speculation happen with shares and bonds, right? So this is the speculation only. So here you can speculate. So this is the speculation example that we are doing. So you have bought a share, and this your understanding of the situation is the share price of the stock will go up, and therefore the future price will also be higher. So you bought it at this rate, and now the rate has gone to this. The future price has moved up, and if you want to sell your contract, you can do that. You can you can sell your contract at 2110 strike and can accordingly make profit. So if you look at this, so that is the rate on which you can sell this and make. So how much profit you made? You made a profit of 3000 rupees in a matter of 2 days only. In a matter of 2 days. But you need to remember there are downsides also. When you look at the upside, there are downsides also. Because when you look at the amount, right? So you have done a trade here for 6,30,000. Though you would not be shelling out the entire money, you would just be putting a margin money. So assuming when you go for a trade of this nature, you would be putting a value of around 80,000, right, as the margin money with the exchange. So this money will remain blocked, and this money may vary also depending upon the value of this. If it is goes down, if the share value goes down, as in this value goes down, so this value will also go down, right, as in the future value will also go down. So therefore this margin money will also be changed. So this margin depends upon what is the value, current value. If there is a huge fluctuation in the in the future value of the share, then there is a chances you will receive a call from the broker to top up your margin account. So we'll discuss about that maybe a bit later, not right now, just to give you a flavor like how this thing works. So did you get an idea what we are talking here? Any question you have which is not clear? Okay.
Sir, sir, what's that margin money?
So if you look at this margin money is basically it is a sort of a it is sort of a collateral which is being taken from you to cover the downside risk which are there in a trade. So it is expected, looking at the current situation, the trade, if we continue with the same situation over the period of a month or so, there would not be a risk of more than 80,000. There would not be a risk of more than of 80,000. So when I say there would not be a risk of more than 80,000, that means the price of future the share would not go to such an extent wherein there could be a loss of more than 80,000. And if there is a loss of more than 80,000 rupees, so the exchange would have to cover that loss, right? So how would exchange cover? Exchange can cover that loss from the customer only who has taken that position. It is the customer who is taking that position. So customer has to put aside a certain amount of money so that the downside risk can be covered. So this is looking at the current situation. So that's the reason why I said this margin money, which is 80,000, can change, and it can go up to 1 lakh also over the period of time if this price of a share continues continues moving to the downward direction. So assuming if the share price moves to 2000 next day, right? So you how much you're losing? You're losing 100 multiply by 300. So 30,000 you have lost, right? 30,000 you have lost from the 80,000. That was the margin money that you put. So now the money is only 50,000 with exchange. Okay. Next day, I assume the price of the share goes down to 1900. How much you lost more? 100 again. So 100 means 100 and multiply by 300. You're getting
That's
sense what I'm
60,000.
saying? Yeah. So now 60,000. So how much money is left with your exchange? Only 30,000, right? Only 30,000 is
20,000.
left. Uh, 20,000, right?
That's it.
Right. Absolutely, 20,000. Correct, 20,000. Now, see, 20,000 is left. There are risk increasing. Assuming the next day again, this goes to 80,000, 1,800. How much you lost? So you are
90 minus 10,000.
10, minus 10,000. That means your deficit in your account. Now, in a matter of 4 days only, in a matter of 4 days, right? These are 4 days I'm taking in a constant, just to make you understand the concept. So in an extreme situation where the market is extremely volatile and it's just moving down, so there is a risk increasing from the trade point of view, and that risk has to be covered by the investor himself. Exchange can't bear that risk, and given this margin money is just depleting with every passing day, therefore exchange would be passing an instruction to the broker, and broker would be passing instruction to you to top up your margin account so that there is enough cash available to take care of the risk. Why we are saying the risk? Because this trade is not settled as of now, right? You have not paid the full value. Did you give 6,30,000 to the exchange? No. How much you paid? Only 80,000 in the beginning, right? 80,000 was the margin amount which you paid to your broker in the beginning, right? So when this phenomena continues, so that means the risk is there, and there could be a time wherein if this margin continues depleting, then there could be a call coming from the, especially what happens, I'll tell you. There is a maintenance margin also. When there is an initial margin, there is a maintenance margin. So maintenance margin is a number. It's just a number assigned to an account. If your money in the initial margin account goes beyond that maintenance margin, then you receive a call from a broker on behalf of exchange to top up your initial margin account. So this is basically your initial margin account that we are talking about here. The 80,000 rupees which you are having is an initial margin account. Next day it is 50,000 for 50,000 because of share price moving to the downward direction. And there could be a situation wherein if it is goes below 20,000, you need to top up your account to the 80,000. So that means you need to put 60,000 rupees more in your account to make it to the same figure which it was in the beginning. So now your this account would show like this the next day. Okay, because you have, when it was 20,000, you put in 60,000, it came to 80,000. So that means there's a minimum amount, the maintenance margin that we term as, and if it goes below the maintenance margin, then you need to top up your account to the same amount where it was done when you actually went into the trade. Getting the idea, or some confusion, some thoughts?
No, sir, clear.
Okay, great. Okay, let's move on quickly to the other slides because we have lot of things to do. Okay, so this is that's the reason when you look at this thing without putting up the full cash value, right? The term, when you look at this term, this is the reason it has been written that way. And it can be a delivery based settlement or cash settlement. So when you say delivery based settlement, that means if at the end of the maturity, if you want to take the delivery of the share, you can take the delivery of the share. Or if you just want to take the profit and want to settle in cash, that is also you can do. So you have got two choices when you look at the future contract. Either you can get the delivery. So what with this contract, what you were doing, you wanted to buy uh, TCS future contract, or you can say in other words, you wanted to buy 300 shares of TCS with this futures contract after a month of after a month. So the period is 1 month, and at a rate of 2100 rupees. That means you would be putting out 66 lakh 30,000 rupees to buy 300 shares. So you can either take a physical delivery of share, or you can also just take the profit. So you have these two options. So how can you do that? Probably we know already this, because we have discussed this. So you can square up your position if you are like the one that we discussed here. So if 2110 is the price of the stock, you can close your you can close your you can sell your entire lot, and the profit is 3000, so that that profit you can keep and you can remove from the position. So that is how you can actually do cash settlement of a particular trade. So this is primarily an example of a cash settlement which I've given. It can be done even after the 2 days time, and can be done even within that period of 1 month, or even at the end of the period, at the last day of the settlement also it can be done. So that couple of things to remember: it is not necessarily the settlement is need to be done only at the settlement date. Future gives this leverage wherein you can even move out of the position before the actual settlement, which you agreed when you actually bought the future contract. So that's a good thing about the future, which is not same in forward. Okay, any question? Speculation hedging, we have already seen this. We know what are speculators, what are hedgers. We will not be spending time here. Value of derivative contract, we know this now, how the value of derivative contract are determined. So the market trends affect the value of derivative contracts. As in the bear and bull market, a derivative derives its value in the bull market by the rising prices. The value is affected, or the vice versa. From the definition, derivative, the value of underlying directly influencing the contract. The other factors like volatility. So be clear with the derivative pricing, especially from the future. Options has got a different pricing mechanism that we will discuss when we do options. But when we look at from the future point of view, so the price, the supply and demand is the one factor, because whatever is happening in a normal cash market, that would be leading to the prices in the futures market. At the same time, the interest rate, the risk-free interest rate, and if it is a commodity, then the storage cost would also be associated. And if it is a stock which is giving a dividend, which has already announced a dividend in a month's time, so that would also be priced when the pricing of a derivative is being done. Volatility is, what is the volatility? Any idea? Volatility, we
As in
discussed this.
fluctuating every now and then.
Right. So volatility is basically the fluctuation in prices, the price which goes to the downside, then it goes to the upside. So this fluctuation is termed as volatility. There is another term that is called implied volatility. So volatility is primarily, we talk for options. So we would be discussing this tomorrow when we start with the option chapter. What is the bullish view, bearish view? We know what the bullish view is, what the bearish view, right? Importance of speculator. Do you think the speculators are playing some role in the market? Are they important to the market? Do you think, or they're not important? What are your thoughts around it?
It's important because they bring the liquidity in the market.
Mhm. Right,
Otherwise, it
right.
will
It
be
is
very
important.
otherwise it will be very difficult for the speculators and arbitrageurs or hedger to arbitrager and hedgers to work on this market.
Mm, correct. So you rightly said. So speculators are also playing a good role in the market, though they are there with their own reasons. But speculators also create a liquidity in the market, and liquidity is of very important. It is of utmost important in the financial market, because without volatility, investor would not be interested to put their money in the financial market. So liquidity is one thing. Because of that, the investors are there, right? Anyone who buys or shorts a security with the expectation of a favorable price change is a speculator. That we have done, right? The role of hedger enters the market to protect the investment in the underlying. They can easily transfer the risk to the counterparty who has an opposite need or view about the market, right? So hedger, when you look at the hedger, so what the hedger is basically doing, the hedger is basically transferring the risk of of the asset to another investor or another trader who is willing to take on that risk. So that is what the hedger is doing. So hedger is hedging his risk by passing on that risk to another individual. So risk is not mitigated. Risk is passed from one individual to another individual. That is what is happening in case of hedging. It is not the risk is mitigated. No, risk is being transferred from one person to another person. So that is why this hedging is being that is how this hedging is there. But yeah, in a sense, the person who's taking hedge, so that person is able to mitigate the risk for himself. So this example we were talking in the last class also. So are we clear with this example? And even not clear? So there is an exporter, there is a trader in the US, and trader and exporter have done a deal, and the spot price, it's a 3 month contract. It's a 3 month contract, right? And the spot price in the market at the moment is USD INR is 70. So one USD equivalent to 70 INR. And there is a fear factor. What the fear factor is, rupee can appreciate. So when rupee appreciate, it may go to $1 to 65. Can you see this thing, everyone? So this is a fear, right? And this fear is in the mind of trader, which is in US. So trader is exporting garments from an Indian vendor, and the deal has been struck, and the deal is such wherein when the exporter has to sorry, the trader in the US has to pay 100,000 USD, right? That's a deal. That's a deal which has been done, and the garment worth 100,000 USD would be taken by the trader in the USA. Right now, the spot rate is USD versus INR is 70. But there is a fear factor, which is the rupee can appreciate. If rupee appreciate, that means the $1 becomes 65 in 3 months. So so instead of so so when you look at this here, so it becomes more for the trader in USA, right? So trader would be able to, so you can see there is a loss of the 5,000. 5,000 is the loss, right? Because it becomes the total value of the contract becomes 65,000 rather than 70,000 when the spot price was 70.
Sir, losses to the exporter, right?
Yes,
So, so
yes,
the
right.
exporter will sell this contract
Yes. So the exporter has got a loss because why?
because of the increase in rupee.
Right, right, absolutely. Because the increase in the FX rate, correct. So
Yeah.
so right. So like assume or exporter, when the exporter is agreed with the another merchant, so they are just agreeing on the value of the contract, or the contract, rather on the contract, I would say. So they are ready to buy a garment which is worth 100,000 USD at this moment. But this 100,000 USD can change basis the FX rate changing in the market, right? So whatever contract that we have done today may may diminish in its value if this rate changes. So exporter is supposed to receive 100,000 USD, right? Or you can say in the Indian currency it means 70,000, 70 lakh rupees. How much is this? 100,000 lakh, 10 lakh, 70 lakh rupees, right? But how much would he receive now? He would receive 65,000 rupees because of change in FX rate,
But sir,
right?
in spot
Getting
price can also be fixed for the contract. Like if today's spot price, if today's USD rate is 70
hmm,
rupees, So the contract can also be made on the basis that on today's forex price, the contract will be uh,
Yeah.
for, will be redeemed after 3 months.
Yeah. So yeah, that can be done. But who will do that?
So it will be in the contract that on today's price, which will be converted into $1 lakh.
No, no, no. So if you go with the like, if let's take an example, you are uh, you are in US, right? You are like same example that we have here. You are in US and I am in India, right? And I'm the you are the exporter, right? And giving goods to you, right? So when the deal is being struck between the two party, between you and me, probably we would not be agreeing with a mechanism wherein we agree for the rate. But we are agreeing with the product only, with the product itself. So I would be giving the product to you, and you would be giving me the money, and the rate is decided. The rate is what rate you are giving. So that would be done with the spot price only. But now, as a exporter, you know there is a risk involved, right? There is a risk involved because you would have to pay more money, right? To the person if in case there is a change in the spot price in future, right? So this is a spot price for the current spot price. But if there's a change, so you would have to buy a forward contract. So we'll talk about the what forward, the one that you talked about. So that's a contract which one party has to buy from outside market to cover the risk which the deal has got, right? So that contract is not covered by the party doesn't give a contract, so you will have to buy that contract from a bank. So bank would give you an FX forward contract, that is called FX forward. There is a contract term FX forward. We'll talk about that with an example, another example also, so that you have an understanding what we are talking here. So right now, just to give you an example what the hedging is. So hedging is basically when an exporter goes to a bank, right, and covers the risk of that fluctuation which is coming in the rate. So that rate he can decide with the bank he wants to have a same rate, that is US $1 at the 70, and with for this rate, to agree this rate he has to pay some commission to the bank also. So the bank would take that commission from the exporter or from the person who is signing that contract, and therefore now whatever happens to the value to the 100,000 USD in terms of the FX rate, he would receive the 100,000 USD from the bank. So we'll talk about this example later on with one more example so that you understand. So did you get the idea what I'm talking about? So when you are doing a deal, so with two
So,
entity, yeah,
so I have a
so,
doubt. Like the trader, once he does for $100,000, once
hmm,
he has booked the deal. So why
hmm,
will he be worried about the interest, worried about the USD INR price? Because this
okay,
particular he would only have to pay $100,000. It's the
yeah,
exporter who would have to bear the exchange rate, right?
right, absolutely. Exporter has to bear this. So the risk is with the exporter. Risk
Okay.
is with the exporter, not
Trader.
with the trader in the US. No. So the
Okay.
trader in the US would be paying how much? 100,000 USD.
Yeah, so then why will he be interested in like in converting this particular
Because
like in this
exporter is based
hedging?
out of India, right? Exporter is based out of India. So here we're
Mm-hmm.
taking a cross currency deal which is being taking place. So exporter is in India, right? And
Mm-hmm.
exporter would require USD, would require INR to run the
Mm-hmm.
operation, right? So
Mm-hmm.
deal has been done in USD, given
Mm-hmm.
the trader is in US, but at the end of the day, I would need money in INR, and that INR I would be using to run my operation, to pay the salaries to the employees and all that thing, right?
Yes,
Getting
sir.
my So therefore, this whatever deal I've done, that's a 3 month deal. I've not done a spot deal. I've done a forward deal or a future deal for that matter. So future deal at a spot price, at a spot price. So spot price right now is
Mhm.
USD
70.
1 USD is equal to 70. But there is no guarantee of having this this rate in future. This so here
Okay.
the example that we are talking about is the trader is giving you this deal, but this is not how it happens in the real life. So the hedging has to be done separately. Hedging would be done by the exporter. By Exporter would be doing the hedging with his own bank, right? So because this person would not be covering the risk, getting the which you
Okay.
already said. You also said
Mhm.
the same thing, right? So why the trader, why the person who is selling the garment would be bearing the risk, which is a good point. Absolutely a nice point, because when you are selling some product, you are not bound to pay the risk associated with the deal, right? So the risk has to be covered by the exporter himself by taking a forward contract with a bank. So exporter would be taking a contract. This is a contract which he is taking to hedge the risk. So risk is the getting the value depleted or depreciated, right? This is the risk. So what the exporter can do, exporter can reach out to his bank and can ask, can you give me a rate of $1 equal to 70 rupees, right? So bank would say, okay, I can give you with some margin in it. So I would give you 70.5.
Okay.
$1 equal to so 0.5 is mine, rest is yours. So whatever happens to the dollar later on or the price, that doesn't, you need not bother. I would be paying with this rate only.
Okay. So if it goes to 65, the bank would still earn a profit.
Yes, the bank would be doing another deal. The
Okay.
bank would not be losing out there also, because even because if the market turns out really negative, so the bank would be
Mhm.
doing another deal. So what they do in a real sense, I'll tell you.
Mhm.
I'm not sure whether you can really understand everyone at the moment. So when this kind of a deal is done, so bank actually borrows uh, that amount, the equivalent 70,000, right? Because what the exporter is supposed to receive, exporter is supposed to receive 70 rupees and multiply by 100,000, 70 lakh, right? Exporter is supposed to receive 70 lakh, right, in Indian currency, if you look at from the Indian point of view. So what
Yes,
the
sir.
bank would do, bank will actually borrow the physical money, right? Because bank cannot be exposed to that risk, because they know there could be a probability wherein they would have this rate really goes to 65. So that means they would be giving 70,000 worth of money to 65,000 of worth of money into 70,000, 70 lakh, sorry, 65 lakh to 70 lakh. तो अभी का रेट जो है 3 महीने के बाद हो सकता है 65 लाख बन जाए, जो कि 70 लाख आज चल रहा है, right? So bank ऐसा नहीं कर सकता, bank can't do this. So what the bank does in real sense, in the on the ground, the bank actually borrows money from money market segment, and what they do, that money is with them, and they lend that money to another person at another interest rate. Because what they do, they buy at the same rate. The moment you go with a trade, right, you going with a spot rate, and now you want to lock your rate. So what the bank would do, bank will borrow the money from the money market segment, the equivalent amount which you want to have at the end of the 3 months from the market, and given you would not be using that money, that you would be getting 70 lakhs rupees only at the end of 3 months. So for that moment, for that period, what the bank would be doing, bank would be lending that money to someone else to keep receiving interest, right? And at the end of 3 month period, so money would be bank will receive that money back from the lender. Bank would continue paying the interest to the borrower also at one side, and continue receiving an interest from one side. So this is a complex thing. It's not so easy that which you, when you look at this thing on the picture, it looks to be a very simple one. It is not that simple. So What the bank is doing two things here. So one is the exporter reaching out to bank. Exporter is asking, I need to lock in a rate. Right? Bank say, okay, what rate you need? He says, I need $1 equal to 70 rupees. Bank say, okay, fine, I can do that. I need some point or percentage point on it. So bank agrees or the exporter agrees that difference of zero point 0.5. So he's ready. Exporter is ready to give a zero point 0.5 to the bank given the risk involved in the whole thing. And at the same time bank cannot just sit idle and do nothing about the situation, because bank is not, they are not god, right? They're not god. They can be sure like this price will not go down. This price can go down, it can go to 65, which the exporter is fearing, the bank people will also fear. So what bank will do, bank will actually borrow 70 lakh rupees from outside, and given it they need to pay the 70,000 rupees to the exporter at 3 months. So for 3 months they will again lend this money to someone. They will keep paying the interest to the party where they borrowed it from, and keep receiving interest where they have lent it for now. And after the period of 3 months, so they will just get this money, send it to him, right? And they will look at the interest which they were so the difference should be such so that they can actually make profit out of the whole thing. Did you get the sense what I was talking here? There were three things which were happening together. So in a real
Mhm.
sense, this is how this deal takes place. But maybe I can talk about this bit later again, because when you actually get some more information about the futures that we are discussing, then we can further discuss about this concept. But this is how the deal actually takes place on ground, which can look a very simple deal, but bank can't have a risk on its book, and therefore they actually do all these kind of transaction to manage the risk and to manage the transaction flow, and manage investors also with them. So because investors need all these products, right? And this is a forward deal which is being taking place actually to one party to another party. And
Mhm.
so forward, is illiquid deal. Forward is a customized deal, so you can't have liquidity there. So therefore the bank has to do necessary paperwork or necessary arrangement for the deal to happen. So the arrangement is done in this form. So anyone got an idea? Sumit, did you get the sense what I was talking here? Because it was a bit complex. Probably we can discuss later also. But did you get some sense?
Yes, sir. I got some sense, and actually I worked on hedging purpose, on
Hmm.
hedging on currency, which is called currency hedging.
Yeah.
Uh, in
We'll also
my
discuss
work
about
experience.
currency swaps. Currency swap. What's the difference between currency forward and what's the difference between currency swap? That's a very significant difference, and that's the difference we would be talking once we are through with this entire presentation. Then we would be taking those examples. Otherwise, it would be a bit difficult for you to understand. So the example that I talked about right now is about currency forward. The currency forward example I talked about. So this example versus the swap. There are two examples. These are two examples which you should understand thoroughly, and you should be so confident that you can make it understand to anyone, right? It is necessary when you are talking about derivatives. So you should be. And then there is one more, that is interest rate swap, right? There are few more. I would not say just two or three. There are few more. I would say equity swap, total return swap. All these we would be doing, right? So we would be we need to be clear with the examples. So I would be doing these examples and to make you understand how the entire thing happens. So let's move on. First, finish this the content that we have in the presentation. Then we will take up these examples. Okay, so examples of hedging: a portfolio manager is worried about the fall in the market value of a particular security which he wants to hold for the next 3 months. How can he mitigate the risk? A construction company is worried about. So this is for you to do. This we have already covered with these examples here. More or less, the example is done. So you need to do it today, and probably tomorrow we can discuss these examples only. It is just a hedging is being done here. So we can discuss them three questions tomorrow. So what the hedger is a risk averse person, right, who is not ready to take risk. And who are speculators. Speculator are the people who are ready to take on risk, and they want to make profit basis their own judgment, right? Exchange traded, two types of derivative we have. One is your exchange traded and other is the OTC derivative. What the features of these two? You need to be very clear with the features. One is a regulated market. We have exchange standard agreements, guarantee of completion of operation, no customization. While on the other side, it is unregulated market, no central clearing houses, bilateral agreement, customization. Right? Okay, so contract that are traded and privately negotiated directly between two parties without going through an exchange or other intermediary. So this is called your OTC contract. So wherein two party are negotiating the contract and they discuss the deal together, and then they come out how the deal should look like, and that deal is termed as OTC derivative deal. So features of OTC derivative is it is less regulated, no centralized place. But as we discussed the other day, the OTC derivative is also changing. Now we have got CCPs in OTC derivative. So entire OTC derivative has not changed in the CCP environment. CCP is central clearing parties. So central clearing party are same like the exchanges. So these CCPs have started coming in OTC derivative space also, and some of the derivative space is slowly and gradually moving on to CCP environment, just to ensure more control and more systemic approach there. So okay, okay, one thing. So did you all receive this invite for a class, right? Everyone received the invite, the online
Yes,
class,
yes.
because I
Yes, sir.
everyone
So
fine.
what about the feedback of the last class that we did?
Yeah,
Interview.
I'll share the feedback maybe at the end of this class, because the common feedback I'll share.
Sure, sir.
Common feedback as in the common input I would share, and the one-to-one I would be sharing when I'm there, as in face to face. Then I would be sharing your as in one-to-one feedback also,
Sure, sir.
right?
Mhm.
So bilateral agreements, right? So customization, flexibility. So the these are the features of your OTC derivative market. So when you look at the exchange traded derivatives, so exchange is basically there is a central place available. Every buyer or seller would be on that central platform to negotiate a deal or to carry out a deal. So it's a order driven market. You can see the order, you can put in your price, you can limit your order, and accordingly you can buy a trade from the exchange traded derivative. So future and options are two derivative products which are and other commodities also, so which can be traded from exchange in the derivative space, right? So future options and then the commodity derivative is available on exchange. When you talk about commodity, basically it is all about metal, precious metals, right? And the gold trading, right? And other metals, they all come under commodity only. Give me a second. So these are the world's derivative, as in the exchanges that we have around the world: Korea Exchange, Eurex, CME Group, Chicago Board of Trade, New York Mercantile Exchange. So these are the derivative exchanges that we have around the world. Okay, so derivative is divided into two parts: the exchange traded derivative, and then you have over the counter derivative. So these are the two broad segment, and under these broad segment, when you see the future and options are the two which are traded under exchange traded, and then the forward and swaps are primarily under the OTC market, right? Okay, so when you go on the list, there is no definitive list of derivative products. So can you see? So there can be many n number of permutation combination made out of these four: futures, forwards, options, swaps. So these are the four broad derivative which are there, and using the permutation combination, there are lot of derivatives available. Okay, hope we are clear with what futures, with forwards, options, and swap are. This basic definition one should be very clear of. Futures and forward, and options and swaps, right? So these are the basic terms that we need to be clear with, so that we can. Okay, what are futures, what are forwards? Because it shouldn't be that we are doing other examples but we are not clear with your basics. Basics is basically, these are the basic of derivatives, and basis this we are making other complex derivatives. So permutation combination is being done as a futures and forwards are same, right? So what are futures? Anyone? What is futures? What is the definition
Sir,
actually?
future and forward are same, but it is a differentiate in the sense that future are trade on
Hmm.
the exchange and forwards are mostly trade on OTC. I guess it is the main difference.
Right, right. Correct. Sorry. So if you want to, maybe if somebody wants to define what the future is, so how would you define a future? How would you define, as a
So,
definition? How would you define? Yeah.
so future is a financial agreement between two parties
Mm-hmm.
at a agreed price,
Mm.
which is going to be redeemed in future, and future are mainly done in exchange.
Right. Right. So
So like,
yeah. Mm.
so futures are standardized. These are standardized contracts that happens on stock exchange,
Hmm.
and it is
Right.
simply a standardized forward contract, sir.
Right. Right. Your standardized forward contract, you can put it that way also. So, and the important thing is, these are standardized forward contracts, standardized contract wherein you are predetermining your price, quantity, and the settlement period, right? So here both the parties are obligated to fulfill the obligation, right? This is the important thing to, when you look at future or forward for that matter. So the important thing is the future happens on exchange one, and you are agreeing to the quantity, price, and the settlement period or specified period for that trade beforehand, before going into deal, and at the same time it is done within an obligation that both the parties will be obligated at the end of the maturity, right? So that is your future contract. And what is forward? Forward is same, ditto. The only difference is forward is done in your
OTC
OTC.
market.
Rest will be same. Futures and forward is ditto, I would say. The only thing is the difference is the forward is done in OTC, futures is done in exchange. Otherwise, the terms would be same. Technical details would be same. Now coming to option, what is option? What is option? Because we need to be clear with this definition, and then for sure the example that we would be doing, we should be clear with those examples also. It is not only a definition that will work. We need to be clear with all kind of example that we will be doing under the derivative section.
Sir, I have a doubt.
Yeah.
Like
Yeah, tell me.
what I've noticed, sir, like futures contract are short term and like forward contracts are long term. Mostly, I've seen that. Is it
Yeah,
true?
that's true. That's true. It may be for long time also. Because forward is a customized deal, right? As we discussed, it's an OTC instrument, so it can be for a longer period. Future has got a maturity of a month, 2 month, and 3 month only. Max to max, it can be for 3 months, not more than that. Though you have an option of rollover, that's a different thing, but it can't be a one-time maturity of more than 3 months. It can't extend uh, in a one trade, right? For more than 3 months. But if you talk about forward can have a longer maturity as well, because these are the OTC contract wherein one party is signing a contract with another party and they can agree to the terms and customization as per their requirements. So these can be a longer deals also, can be of 6 month deal also at times, and can be a longer, right? So the forward may differ in that sense, right? And what are options? How would you define option? Anyone? Any clue? Option? What sense you make of this option as a word? Go with the word only.
Either
Okay.
or, like.
Yeah, right. Either or. Very good. So here, when the party go into trade, they agree for those things would be same. The predetermined quantity, price, settlement date would be there, right? There is no changes to that. The only thing is when party is agreeing with another party, so the one party has got an option to execute the trade at the agreed strike price or the exercise price that we say, and another party has no option but to fulfill that obligation, right? One party has an option either to exercise the deal or to not exercise the deal, right? Or another party has no option but to obligate the request which the another party has put forward. So if they want to exercise the deal, so that deal has to be exercised by the seller of the party, and buyer has an option to either execute or not execute the deal. So buyer has got this option wherein he can either get a deal executed or cannot get the deal executed, whatever he thinks is best for him. So as we know, this option gives a bit of a good uh, good deal for a buyer. So buyer has to pay a premium for the deal, and that premium is basically a profit for the seller. Getting the idea? What the options are?
So basically, it's a contract of buy or sell.
Yeah, it's a contract of buy and sell, like in futures also a contract of buy and sell only, right? But in futures or in forward, both the parties are obligated to fulfill the contract. So if I am the buyer, you are the seller, then you are bound to uh, you're bound to obligate the trade at the end of maturity. You cannot run away from your obligation in case of futures and forward. But in case of option, wherein as a buyer I have agreed for a deal at a predetermined price, a predetermined quantity, for a predetermined quantity and for a specified period, I have an option either to get that deal executed as a buyer or to not get that deal executed. So given I have got this option, therefore I am required to pay a certain amount of a premium to the seller, and seller is bound to obligate the deal at the end of the maturity if buyer wants that deal to be executed. Getting the idea what I'm saying? So to just to give you another example so that you can understand, like the TCS example that we discussed, right? Just to come on the same page. This was the
So
futures
to,
example that we were talking. This is a
so
futures example,
basically,
right?
basically, it's depend on the contract they hold.
Uh, when you say depends on the contract they hold, I did not actually understand the full meaning of it. If you can maybe elaborate a bit more. As in,
Like,
depend on
sir,
the buyer, right? You're saying,
yes, sir, of the buyer.
yeah, on buyer. So buyer, when would buyer when would buyer like to execute a deal? Just think that way. As a buyer, like you are a buyer, I'm a seller, right? Why,
Yes,
when
sir.
would you like the deal to be executed? You would like
When
deal to be executed when you are in profit, right? Simple.
yes, sir. Hmm.
When you're losing, would you like the deal to be executed?
Yes,
No,
sir, sure.
right?
No.
And given you are getting this option of backing out of a deal when you're losing, therefore you would require to pay a premium, and that premium would be a direct profit to the seller, right? So just to give you another example of option to quickly and make you understand this, like you same example, I'll take TCS as a underlying asset for this derivative contract. Underlying lying asset, right? So I'm taking one option contract, buying one option contract. So that means 300 shares, right, at a strike price of uh, 200, and the spot price is 2100. And just before I detail more, there are two different kind of options available. One is the call option, another is the put option. Call option gives a buyer right to buy the option contract at a predetermined price, right? So this is a call option, and the put option gives the buyer the right to sell the contract at a predetermined price and a predetermined uh, strike price. So strike price is already at the predetermined period, right? Clear, everyone? So now it's a call option. I assume buying one option, that's a call option. So what I'm trying to do here, any idea? Can you see this, everyone? So what is this contract is all about? So there you are buying a call option, and the call option gives a right to buy the number of the contract that you have agreed with the seller at a predetermined price. So predetermined price is 2200, strike price is the predetermined price, and for that you are required to put aside a premium. That premium would be a profit to the seller, and so premium is 1500, assuming it is 5 rupees per share multiplied by 300, so it is 1500. So how that is calculated, I would be talking later. So that's the premium valuation that we will be discussing later on, not right now, maybe tomorrow's class. So can you look at this? I'm saying if if the strike price goes to 2200, then I am buying this contract, right? And for that I'm paying a premium of 1500. That is what is being done with this deal. Any thoughts? Any questions?
So, what exactly is the spot price?
Spot is as in the current price right now. The current price, as in today's price, is right now the current price of the TCS share is 2100, right? And this is a 1 month option contract. So if after a month, the strike price is this. Would you like to execute the contract? Yes, you would like to execute. So it can be executed only when the strike price is 2200 or more. Getting the sense what I'm saying? In case of call option, when the buyer
Yes,
of the
sir.
call option is taking a position to buy a option contract, so they are agreeing for a strike price of 2200. So that means the strike price goes 2200 and beyond. Only then the deal can be executed. Otherwise, the deal would not be executed. So deal would be null and void, and that 1500 would be the profit for the seller who is actually selling this deal to the buyer. So that 1500 will remain with the seller, whichever the case, whether the share moves above 2200 or it remains under 2200. In both the scenarios, the 1500 rupees, which is the profit, is the only profit for the seller, nothing else. So seller is just earning this premium as a profit, and buyer has unlimited profit, has an option of earning unlimited profit.
Sir, how you calculate the profit over here, 1500?
1500, there is a premium mechanism, like there is a way why how we determine this premium, right? This premium which is going to seller. So there is a Greeks option Greeks that we would be doing tomorrow probably. The option Greeks is basically determining the price, so the premium for a particular trade, right? So this premium actually goes to the whom? Seller. It goes to the seller.
Sir, I have a doubt.
So
Hello.
Viva, you there now? Yes, Siddharth, go ahead.
Sir, like this particular option, we the TCS share option, it is a call option, right?
It's a call option, yeah.
Okay, so
This is a
the
call
buyer
option,
has the right to buy.
right? Buyer has a right to
So,
buy when the strike
mhm.
price moves beyond 2200. Or
Oh,
yeah,
okay, so like post 1 month, if the spot price is 2100, so the buyer
hmm.
can still buy because.
Yes, the buyer is obliged to get this deal executed.
Okay.
Sorry, not buyer, seller is obligated to get this deal executed, and buyer will execute it because the buyer knows he can earn profit. How?
Because
So
the amount is less. Is
no. So your strike price is 2200, right?
Yes, sir.
But as in your buy price is 2200, you would be buying
Mm-hmm.
at 2200.
Okay.
You bought this option at 2200 only, right?
Mm-hmm.
No, not 2200. Rather, I would say 1500 is the premium that you paid to buy this deal. That's the only
Okay.
price that you paid, right?
Mm-hmm.
Now you are saying when the strike price goes beyond 2200, right? So you would like this deal to be executed. You would like this deal to get executed. So that means if the price goes to
20.
2210,
Mm-hmm.
what is the difference? Difference is 10 rupees, right?
Yes, sir.
Difference is 10 rupees. So
10
10
rupees
multiply 10
to 300.
multiply 300.
3000.
That means 3000 rupees profit you can make, and you can do it a cash settlement. Another way, this is a cash settlement that you're doing. You can also take a physical delivery, right? You can also take a physical delivery. So you would be taking a physical delivery at what rate? At 2200 rupees. So 2200 multiply by 300. That means you need to pay only 6,60,000 to
Mm-hmm.
buy 300 shares of TCS after a month. And if the share price is 22,500, so you know your shares value is 300 multiplied by 2250. So that means this is the value of those shares which you are buying from the seller at that point in time after a month, right? So most of the time it is a cash settlement, because any which ways you're just going to earn profit. So it is the wish of the buyer, what the buyer wants to do. Buyer wants to do a physical settlement or wants to do a cash settlement. So most of the time it is a cash settlement the buyers do. So can you see what I'm doing here? So if the share moves beyond 2200, only then it is profitable deal for the buyer, right? Only then there is a profit. Otherwise, there is no profit. If there is no profit, why would I execute a deal? So my premium is already gone on day one itself. On day
Okay.
one, when I executed this, when I actually went into the derivative deal, so that point in time, this 1500 rupees as a premium was lost. So that was already given to the seller. So
Okay.
seller's profit is only 1500. That's it. Nothing more, nothing more, nothing less. And my profit can only begin when this spot price 2100 is right now actually moves above 2200.
Oh,
Only then I can make profit out of this option deal. So that's the reason I've said, when you look at the call or when you look at the option, there are two quite different kind of options available in the option space. So the call option has a right, it gives a right to the buyer to execute or to gives a right to buy a share at an agreed price at an agreed time. This is the this is what the call option gives to the buyer, and seller is obligated to fulfill that right. Seller has got no option, either to fulfill what has been exercised by the buyer. If exercise is not done, if the buyer doesn't exercise his option, then okay, seller is fine. But if buyer wants to exercise it, then seller is obligated to fulfill that obligation. And put gives a right to
sell.
sell a contract at a specified price and at a specified time, right? So specified time, already. 1 month is the example I've taken. 1 month is a specified time. The price, 2200 is the example, right? So these are the two things which you already know in the beginning. So what price you would be buying at, right? And after what period you would be buying at or selling for that matter, if it is a put option, right? In this case, it is a put. So why would you do a put? Put similarly, just to put it here, make it a put one. Okay. Now the spot is, I'm assuming it is same 2100, which is I've taken above. I'm taking a strike of 2000 this time. Premium I'm assuming 1500 just for simplicity. I'm keeping this. So what I'm saying here, what do you make out with this thing? What I'm basically telling to my seller as a buyer of a put option. So I'm
Right
saying
to
I would
sell.
like, yeah, right to sell, right? So I'm saying I have a right to sell one contract of TCS at a strike rate of 2000 rupees
at a premium of
at
1500.
a premium of 1500 rupees at a certain time interval. Getting the point?
Yes.
So, how would you, when would you execute this deal? You would be executing this deal only when you see the the share price actually moves below 2000. If it doesn't go below 2000, it would not be a good deal for buyer, because the buyer would not be able to make a profit, right?
Yes.
How would buyer make profit here? Assuming the
When
share price goes 1950 on the settlement date or after a month. 1950, right?
yes.
So how would buyer make profit?
So the margin between 2000 and 1950 into 300 years, that would be the profit of the person buyer.
Yes, yes. So you can clearly see, because the buyer can buy the shares at what rate? From open market, buyer can buy at 1950, right? And can sell at 2000 rupees. So
Yes.
50 rupees, difference of 50 rupees is coming on a share. That is very clearly shown there. So the accordingly that profit and loss would be reflected on a deal also. The profit and loss is reflected. It is not the buyer has to go in open market and actually buy them. I'm just talking from the physical settlement point of view right now. If I need to do a physical settlement, that point of view I'm telling you. But if you look at this deal, if the share price of a trade actually moves down to 1950, and if you maybe I'll show you a live also. For a Give me a second. I'll give you a screenshot because so that you can understand what actually exactly I'm talking later on. Okay, no worries. So idea is when you look at option, right? So option is a financial instrument, gives a right to the buyer to either buy or sell uh, the contract at an agreed price at an agreed time, right? So given this is a right which is given to the buyer, so buyer has to pay a premium to the seller, and this is premium is a profit for the seller, and so this deal can be exercised and executed by the buyer only when the buyer finds it is a good deal for him to execute. If the buyer doesn't find any profit out of the deal, the buyer would leave the deal. The profit which is given to the seller would remain only profit. That's it. So there is a potential of unlimited profit in such deal, and there's a potential of unlimited loss for a deal for the seller also. Okay, let's move on quickly. So leverage is basically what a derivative market is doing. Derivative market is giving a sort of a leverage to the traders or the investors in the derivative market. How? Because you do not have to shell out your entire money to buy a trade. If you buy a lot, example the same one that we discussed here about the TCS one. If you go with a normal thing, if you want to buy 100 shares, probably you would have to put in 6,30,000 rupees, right? So that's the money you would have to put to buy 300 share. But if you go for a derivative contract, you would not have to pay the entire money. You just need to put in some amount, that is 80,000 rupees, and you can take a position in this contract, right? So that's a leverage basically. Borrowing funds to make investment, less capital needed than in bond and stock market. Total value of an asset. So this is called notional value. So total value is basically the spot price multiplied by the total value of the contract. So that is called notional value. Why it is notional? Because it's just a calculated value. No one is actually paying that value at that point in time. It is not paid. It is just agreed in paper, and it is showing reflected in the live position also what the current value is going on. So notional value is basically the contract value, you can say. The contract value is termed as the notional value in short. Okay, so spot price, what, so this word you should be very clear with. Spot price is the current price. Notional value is the security, the price of the contract is called the notional value. The contract value would be to call, and it would be calculated with spot price only. So multiply with the spot price the number of shares, that would be termed as the notional value. So if you look at this example here, so if I talk about what is the notional value, the notional value is 6,30,000, right? Because 300 shares multiply by your spot price. Spot price is 2,100, right? So this is your notional value. Clear, everyone? Doubt?
No, sir.
What is the number of contract is basically contract lot is, there is a, whenever you do a trade in derivatives, there is a lot assigned. So every security has got a different lot. So the TCS has got a lot of one lot has got a 300 shares. So other security would have a different configuration. It is not necessarily they would be having 300 shares all the time. So if, for example, the ICC Bank has got how many shares? 1375. So, this lot or the number of shares decided under lot is basically on the value. The contract value should be close to 5 lakh. The contract value should be close to 5 lakh. The 5 lakh should be the contract value. That is how this lot is decided. So it was 2 lakh one point in time. Now it has been revised to 5 lakh. So the contract value for a derivative contract is 5 lakh. That is how it should be. So buy call option, sell, right to exercise the option, purchase 100 shares of ABC for $500. The option holder can lock in 500 profit. What do you understand by this? Anyone? Because we have discussed this. हमने अभी कर लिया ये जो मैंने अभी हमने एक्सेल पे किया वो हमने यहाँ पर हम देख रहे हैं on the same slide.
So this basically explains how the profit is booked in the call option
Right.
contract.
Right. This actually gives you an idea. It gives you a bit of a description or this bit of an explanation how actually the profit is booked. So you are buying a share or a this is so the strike price for the option contract is $5, right? Now the share price moves to $10, right? So how much difference? Difference is a $5. So $5 is your profit, and number of shares in a lot is already given the 100 shares. So 100 multiplied by 5, so 500 is a profit, which is in the contract.
Yes.
Settlement date, you know already. I need not emphasize on this piece. Future date is called the delivery date or final settlement date, right? So this is just a definition. Expiry date is the last day that the option of futures contract is valid. That is called the expiry date. So what is the expiry date in India?
So
In case of
Thursday
option
of
future?
the
Yeah.
Thursday of every week.
Last Thursday of the month.
Yes, right. So in
But
India, it
but
is
in commodity there are different in commodities there are different different expiry date for different commodities.
yeah, right. So for normal future and option, it is last Thursday of the month in India, and if you look at from the United States and European country, it is a third Friday of the contract month, right? So in the US it is different, in India it is different if you look at the expiry. So that means every month on these given days of the month, the expiry of the option contract would take place. It basically means this. So if you have taken an option this month, and rather I would say the next month, the expiry is on which day? Any idea? When is your last Thursday?
So it just went last week.
Yeah, so it happened for this month. What is for next month?
So next
When
month.
is yeah
31st, sir.
31st December, right?
31st December.
Because
Yes, sir.
Yes, sir.
that is your last Thursday, right? So last Thursday of the month is 31st December, so that would be the expiry for the option and futures contract. Okay, so let's move on. So there's a process. There's one thing that is
But
called
sir,
rollover. Rollover. Yeah. Go ahead.
Sir, actually, it's not mandatory that every month's last Thursday is the expiry, because I've been trading in Nifty options and Bank Nifty options. On weekly, every Thursday, there's expiry of these options.
Okay. So, but that is for Nifty, right? That is for Nifty.
Nifty and
Nifty
Bank Nifty.
expiry.
Actually, earlier it was only last Thursday of the month, but exchange wanted
Yeah.
some more value, more expiry, more speculation. So that's why they invented weekly expiry as well, which is also on
Right.
Thursday.
Correct. So right, he's right. So yeah, he's right. Vivek is right. So now the expiry is also weekly for Nifty and Nifty Bank and all, right? So this is weekly also, and Sumit is also right. So earlier it was only monthly, Thursday within it was even for Nifty and Nifty Bank it was monthly only, but now it has been changed. It has been made weekly also. But if you look at from the stock point of view, stock option or stock your future, right? If you take a position in stock, then it would be monthly only. You have this weekly for Nifty and Bank Nifty and all. Okay. So
Okay, sir.
rollover we know
So,
what is rollover. Yeah.
so in
Yeah.
the
Go ahead.
last, in the previous slide, it was mentioned that for US and Euro, third Friday of the contract date. What does that mean? Contract
Contract
month,
month.
sorry.
Yeah. Yeah.
Sir?
Yeah. So it is very same like in India. It is Thursday of the contract month. Every last Thursday. It is third
Mhm.
Friday. Third Friday of the week of the month. Third Friday of the month. In India, we can say it's the fourth fourth Thursday of the month.
Thursday of the
In a
month.
sense, we can say it is the fourth because usually, sorry, usually there are 4 weeks in a month. We assume that way, right? So it
Yes,
can be
sir.
five also at times in a month because but they have very categorically said it would be third Friday of the contract month. So we have said it last Thursday of the month. We have not said the fourth Thursday of the month. We haven't said that way, right?
Yeah,
So
just a different way of saying it.
yeah, different way of saying it. So they have third Friday. So third Friday means third week you will say, and the Friday coming in that week would be termed as third Friday. Yes, Raj?
Yes, sir. Yes, sir.
Okay. Okay. So what is the rollover? Rollover we know rollover is basically when you have a deal already going on and you want the deal to continue for another month. That is given the expiration is in January, and you want this expiration to move on for another month. So that is basically called a process of rollover. So carry bets forward. So you are actually moving your deal to another month. So that is the process, and that process is termed as rollover, right?
So is it possible on the online platform of trading?
Yeah, online platform. I'm not very sure. But I online. I'm not done it to be honest. To be very frank, but I guess there should be an option for online also because now when broker can execute on your favor, so you should also be having this option. Broker for sure can do it, but if the every broker provide this option of rolling over or not, I'm not very sure because I'm not like, ever done rollover. I've not
So
executed using
rollover,
my
so rollover
yeah.
in the Indian context for the Indian market, it happens by if you holding it TCS
Hmm.
future and on the day of the expiry you can
Hmm.
sell the TCS future and can buy the next month future. Uh, this is called
That is
rollover
not.
in Indian market.
No, that is not
Okay.
rollover. That is simply selling the previous option and
But uh,
buying.
but it, but Indian market they term is as rollover that they roll over to the next month no next contract.
So what are the advantages? Are there any advantages while you're doing
There
this?
is no
And
advantages, yeah, there is no advantage, but that you get another month for another you get another month
hmm,
for
okay.
for your contract. Nothing else.
Hmm, okay.
Ultimately, you book loss because you sell the current contract on lower price and bought the next contract on higher price.
Hmm, hmm, hmm.
Yeah.
Yeah.
Ultimately,
So
you lost.
yeah, but that option is not attractive to the investor, right? So because it's a normal option available to everyone, right? So as
Yeah,
an
Yeah.
individual, so
broker do
maybe
that for their brokerage actually.
okay, okay, understand. So maybe I will check if there is something more to rollover, but this is the rollover option available, rollover option in futures and option trades wherein you can do the position rollover. India, how it works, probably we can deep dive bit more and understand later on. Okay, so forward contracts is more or less same with futures as we discussed. The only thing is they are not exchange traded, they are privately negotiated deal done between two private parties. So that is how these deals are, and liquidity is quite less. because these are customized basis the requirement of two different entities, and these different requirement would not be attractive to another third party or fourth party for that matter. So therefore these are not liquid in the market. They would not be and there wouldn't be greater availability of same products to, or greater availability or greater viability we can say for the other parties for these instruments, right? So okay, so this is the same thing. So I'll not spend time here because we've already done on the first page. It's the same thing. Buyer, gold, seller, right? Contract expiry date is this. No payment takes place till the expiry date, maturity. It's a contract. Both the parties are obligated here because it's a forward deal. Same example is here. After 3 months, the contract is at rupees 300, 103 per kg. The contract size you can see, the quantity you can say is 100,000, 1000 kg per contract. And the after 3 months, what can happen? So these are the potential things in potential options available, or rather I'll say potential things which may happen in future. So the spot price may be 105. It can be 101. So if it is 105, who is in profit? Buyer is in profit, right? If it is a 101, the seller is in profit, right? Clear? No exchange is involved. Independent agreement customized. No advance payment, huge risk of default. So the risk of default is higher in the OTC market compared to your exchange traded market, dependent on the spot price. Forward price, the agreed upon price in a forward contract is called the forward price. The price quoted for immediate settlement of the asset, spot price. Spot date, normal settlement date for the transaction. So these are the terms that we use in derivative. We should be comfortable. It shouldn't be that we are not sure what spot price is. It's the current price. It's as simple as that. Spot price is basically the current price of a security at a given moment is termed as spot price. Spot date is the cash settlement or the same day settlement. Forward price is the price which is being agreed for a future date, that is termed as forward price. Simple terms, just we need to understand them. Forward price, spot price, seller, buyer, profit and loss. How the profit and loss is made? Can you just elaborate this from the point of view of buyer and seller both? So this is how the profit and loss is calculated, right? The spot price on the expiry date of the contract and the forward price agreed at the time of signing of the contract. So this is the calculation method given for calculating profit and loss. Simple. So so your spot price on the expiry date of the contract is that price is subtracted from the agreed price, and that is how you calculate the profit and loss. So you can just look at this here. So the deal is done on 1st August. The underlyings are 1000 shares of Wipro. The price is 300 per share. So total value is 3 lakh rupees. Okay. Now here is a seller, is a buyer, right? So buyer is supposed to pay 3 lakh rupees to the seller at the end of the deal. And what may happen? The spot price is 305. So the spot price at the end of settlement 29th of August, that's the end of the settlement, is to 305. So total value becomes 3,05,000. So now you can look at here the long position. The buyer has got a profit of 305 minus 300, which is the agreed future forward price, and 305 is the spot price. So the profit of 5,000 goes to whom? Buyer. In case of short positions, so the seller is incurring a loss of 5,000 rupees in this case. Clear? Nothing difficult here. Any question here?
No, sir.
Okay. So let's move on quickly. Then second example is again the similar one, wherein the spot price is 295 instead of 305 where it was. So now it is 295. So what is the total price value? That's 2,95,000. The forward price is same. The forward price is same here also and here also. So what is the situation now? The short position is 300 minus your 295. That means 5,000 profit, which goes to the seller. Or I can put it 295 minus 300 also. So the 5,000 is the loss for the long position for the buyer, then 5,000 the profit for the seller. Clear? If it
Yes,
is
sir.
same, the spot price remains same, forward price remains same, there is no profit, no loss. The only brokerage charges would be applicable, which you would be paying to the broker with whom you're trading, and that is part of the transaction fees and all goes to the government, and the part of the fees goes to the broker. So the risk are liquidity risk, credit risk, less regulation. So these are the risks associated with your OTC derivative. Liquidity risk, difficult to resell. Forwards are customized deals, therefore difficult to resell. Credit risk, there is a chance of counterparty failing. So the money which you have with money involved can also be lost. That can be in the form of collateral, that can be in the form of the profit also. So profit and collateral both can be lost when a counterparty goes bust, right? So the credit risk is there. Less regulation, we know OTC is less regulated compared to the exchange traded market, so that's one of the risks. Futures contract is similar that we have done. Legal binding agreement to buy or sell a commodity or financial instrument in a designated future month at a price agreed upon at the initiation of the contract by the buyer and seller. Futures contracts are standardized according to the quality, quantity, and delivery time and the location of each quantity. Right, so this is same as we did for the forward and future are same. The only difference is the exchange is there, and there is a standardized contracts compared to the OTC contract, which are non-standardized, which are customized. So here the contracts are more standardized and more regulated if you compare or as opposed to your forward contracts. Advantages, you can see high leverage investment, paper investment generates quick money, offer a fair deal, offer liquidity, minimal commission charges. So these are the advantages associated with futures. Anything which is not clear, what is high leverage investment? We just did it. I hope these terms are clear, right?
Yes,
Okay,
sir.
let's move on. Okay, so this is how this is. So unlimited profit and loss, leverage loss. This is the same thing that we have already covered here uh, in this same thing. Okay, so future contract seller. Okay, so in short sale, we discussed one of the example of short sale in the class also. So you can also do a short sale in futures contract. Short sale is basically selling a contract today and buying at a later date, assuming the price of the security will go down, right? So that is the reason you're doing
Yes.
the short sale. Short
Yes, sir.
sale is with the idea that the price of security should go down in the future date. If it happens, then you are making profit on a deal. If it doesn't happen, then you would be losing out, and there could be unlimited loss. There could be unlimited loss unlimited loss in the deal given if the trade goes in the opposite direction. Okay, so this is how long and short position look like. So long position, when you are a long on a position, so you make profit only when the price move up, right? In case of short position, you make profit when the price falls.
Goes down.
Yeah, goes down. When price goes down, profit falls down, then only you make profit. Sorry. It is determined based on the demand and supply. The price mechanism is same like in forward, like we discussed in forward also. That is your risk-free return, the storage cost. If there is any dividend payment, then the phenomena of demand and supply will always play out. It is fundamentally based on a demand and supply, and then the added thing are there: the risk-free interest rate and storage cost, and the dividend payment on the stock if announced. All these factors would be there for calculating the price of a derivative contract only when this demand and supply is looked at first, which is why it is written here. It is derived from the spot price. So whatever the spot price is, how the spot price comes, it comes from demand and supply, right, in the cash market. So the spot price is the main thing which is actually calculating the price of the futures or the derivatives, you can say in short. So this is how a futures contract look like. If you look at the contract detail, these are the things you would be able to see. So see, the order book basically, this order book tells how many orders are there by quantity, how many quantities people are buying, what price buy price is available, sell price is available, how many sellers are there, the sell quantity, you can see this their seller and what price they're selling, buyers are standing at this price. The market lot is basically the lot at which a contract is available. So one lot is for 2400 rupees or 24 shares, right? And the underlying value for a share is, this is the underlying value for one share is given here, and the trading volume is, this is the trading volume, number of contracts bought and sold today. So that's given here. Value of contract bought and sold today. So that's the total value of the contract. So this you can find on the NSE website. On the NSE website, if you go and click on the futures contract, you can find these detail for any of the shares, be it Wipro, be it any other share. Also, you can see that this detail. This is just to give you a glimpse of how a contract actually look like. So this is just the trade credentials, you can say. These are the trade credentials or trade characteristics which we are discussing. So all these are there. Any questions there? So there were difference between futures and forward, right? Exchange traded, over the counter, standard contract, customized, fungible, hence liquid, bilateral contract, hence illiquid, daily settlement, end of period settlement, margin may not require margin, no counterparty risk, counterparty unknown, counterparty known. Anything not clear here? Anything not clear?
No,
Everything is simple, right?
yes, yes, sir.
Okay. So future contract standardization, same thing that we have covered. Okay. Settlement date, the last Thursday or third Friday of the month, we have discussed already. Contract size, the minimum contract value has to be 2 lakhs. So this was one point in time, but now it is revised. It is 5 lakh, what I understand now, in India. The lot size is the number of shares which a particular contract can have. That is called lot size. Price tick. So what is price tick? Any idea? Price tick is basically at what price you can buy a share. So there could be a change of a price change of price of 0.5 can happen from one buy to another buy. It can't be less than 0.5. It
Is
can't be 0.3.
this is
It
the
can't be point.
this is the minimum movement of the price of any share or any future contract or
Right.
anything. Minimum
Right.
movement.
Minimum movement, yeah, absolutely. So minimum movement can be of 0.5, not low, no, not less than that. It can't be 0.3, it can't be 0.2, it can't be 0.1 also. So the
So
minimum
is it
price
the
tick
ticker?
is point. Yeah, Siddharth.
Is it the ticker price that we are referring to? The price tick or ticker price? Is it the same?
No, this is the price as in the contract price we are talking about. So the example that we took, right? This is the strike price that we took, right? 2100 something. So the next price can be 2100.50. It can't be 2100.3. Okay, it can't be this. It can be 21.5 minimum. Then it can be 2100.01.
Okay.
Right. So this is how the price movement for a particular contract can't be less than 0.50. It has to be in the multiple of 0.50. In the multiple of 0.50. I'm basically, it means that.
Sure, sir.
Margin are predetermined by the clearing member and hence is standardized across all participants in the market. Right. So margin are determined by the exchange only, clearing member, you can say. and it is placed with the exchange as long as the parties are in trade. And the quality, in case of commodity, the quality of underlier is standardized in terms of like there is gold trading also, right? So this quality is also defined: 22 carat, 24 carat, 18 carat. All these things is also specified in the contract when you are actually going for the commodity trading. Then for if you go for the currency pair, then these are the prominent currency pair available in India: USD INR, UER, so Euro INR, GBP INR, JPY INR. So these are the prominent one which are in India. However, if you look at from the global point of view, there are other. India INR doesn't feature there at all. INR is just for the Indian our local currency, but the global level INR doesn't.
There are there are
Feature.
currency contracts mostly.
Yeah, the cross currency contract. They are usually for Indian to take the Indian currency. So we'll talk about those in future in forex chapter. Okay, so in future contract, both buyer and seller has to pay a margin, part of the total value, notional value, to the exchange in order to start the contract. This is used to mitigate the counterparty risk or default. The amount is paid upfront to the exchange and the clearing house, right? So as we discussed, there
Yes.
is an initial margin which is paid uh, to the exchange for every trade that we are doing, and that's a leverage also we say, because we are just paying the initial margin when we initially go into contract and not the entire value of the contract. The entire value, when you talk about the entire value, that is called the notional value of the contract. So notional in a sense, because it is not being paid, it is just a principle which is seen, which we know this is the value, but you are not paying that value in the beginning. So that is the notional value we say. And the initial margin is the value that you have paid to the exchange as a security deposit while you take position in that trade, right? So amount paid at the start of the contract by both buyer and seller is known as initial margin. It is a sort of a security deposit which is maintained by the participant with exchange, right? So this is maintained with exchange, and both the parties need to pay this. It is not only one party would be paying this, it is both the parties would be paying it. So in case of futures contract, I'm saying, not for every contract. In options, it is not both the party, it is just one party. So that is the seller. Okay, variation margin. What is variation margin? Variation margin is basically the daily change in profit and loss. That is called the variation margin. So how much variation is coming from yesterday to today? That would be called, example, today the share price was 2100. Today the share price is 2120. So what is the variation margin? Variation margin is 20, right? 2120 minus 2100. So that's the variation margin you have for this given share, right? As and when the participant take position in the market, if the losses incurred by any participant results in reduction of initial margin maintained with the exchange thereon, participant will need to make good the deposit till the initial margin, as we discussed. So this is the thing wherein if your initial margin is reduced or depleted, as we discussed here also, this example that we were doing, wherein initially you deposited 80,000 to take part in this contract of TCS worth 6,30,000. So you put in a deposit of 80,000 only. Next day the share price went to 1900 or rather 2000. So it became, your value of the your initial margin became 50,000, reducing 30,000, right? So next day it became 20,000 because the share value went to 1900, right? So as and when this initial margin is going down, it is checked with the maintenance margin. If the maintenance margin is breached, in a sense, if you are going below the maintenance margins, assuming in this case the maintenance margin is 50,000 or 40,000 for that matter, right? 40,000 is the maintenance margin. If you breach 40,000 mark, then you would require to top up the value to, voice is not audible.
Audible, sir.
Audible. So maybe Ishika, maybe just try to reconnect, maybe at times due to some as in so some network issue, the voice might not be there. For others, is it fine, audible? Okay. Okay, guys. So we can probably take 5 minute break because we just have 40 minutes left now. Okay, we'll take a quick 5 minute breather and then we will start. Okay.
Sure, sir.
Okay.
Hello, sir. Are you there?
Okay. So everyone there?
Yes, sir. Yes,
Yes,
sir.
sir.
Okay. Okay, fine. So let's wrap it up. Then we will be talking about other things, as in the feedback and all the other things that we have to discuss. Okay, so the future contract, the initial margin, as you said, is something which is there whenever an individual takes position in the futures contract. So initial margin is something which one has to pay to the exchange, and that money is kept aside as to take care of the risk between the trade. So it is taken with both the parties. It is not just the one party has to keep this initial margin. It is both parties, buyer and seller, both has to keep the initial margin with the exchange. Similarly, when you look at the variation margin is a daily profit and loss which is there in the deal. That is what the variation margin signifies. So, example we discuss 2100 is the strike price for TCS share, right? In the Excel file, and so if it goes to 2120, so that is the stock price moving up, and there is a difference of 20 rupees coming from one day from first day to second day. So this is termed as the initial margin. This is the variation margin, not the initial margin. So variation margin is 20 rupees for that day. Okay. So this is the calculation, how the calculation is done to have an MTM profit and loss. So how the market profit and loss is calculated daily is with this. So if you look at this, the closing price for C1, close of day, and the buying price. So what if you want to calculate what profit you had for day one? So this is the closing price for day one and the buying price for day one, multiply by the lot size and the number of the lots. If you have got many, maybe more than one lot, then you need to multiply with number of lots also. So that is how you would be calculating a profit for a given day. Similarly, the same thing, same calculation or logic would be applied for the day two also. The closing price for day two minus the closing price of day one, and then lot size and number of lots all will remain same. So then again, you can also drive the same thing, the thing that you have done with mathematical calculation. You can come with this equation. So the equation is such: C1 minus buying price, and this is common. Lot size and number of lot is common. So right, so you have multiplied with everything with the entire equation with this lot size and number of lots. So what is happening here? C1 minus C1, they will cross out, right? C2 minus C2 will cross out. C3 will cross out with this C3. What is left is selling price minus the buying price, right? So these two things would be left, multiplied by the lot size and number of lots. So this is the profit and loss would be at the end of the deal. So this you're doing for the day one, day two, day three, day four. For the whole month, you would be doing the same way. So the profit and loss will vary on every day. It is up and down for day one, and subsequently it would be for the other days also. And the at the end of the month, this is how we are calculating. So in short, you can say what is the actual profit and loss. That would be the selling price, that's the end day price when you are actually settling it, and the buying price, right? Multiply by the lot size and number of lots, right? So that is the whole thing for calculating the profit and loss. But this is why we are doing this daily. This we are doing because we need to calculate the price or the profit and loss for a daily basis, so that it can be ascertained what should be the amount of margin which is there with the party. So there should be some change in the margin amount. So margin amount can be changed only when it is below the maintenance amount, and that can happen when the share price actually either move too much, too high, or it goes too low. So one side might require to post higher margin amount, right? So that is how it may happen, right? So look at this. Okay, so settlement mode and future contracts. So the ICE brand futures uses this method cash settlement. NYMEX futures exchange crude oil future uses this method upon expiry. The physical settlement, cash settlement, we already discussed what is physical, what is cash. So cash is basically the profit. You take profit, you close the contract. Physical means you actually take the position of the underlying asset that is being traded with the contract. So that you actually take a delivery of that particular asset that is traded, that is agreed when the trade was opened or trade was initiated. So that is what is shown here. Okay, so margin calculation formula that we discuss here is is this is an example for the calculation. So you need not look all these things, but but for understanding you can just try to see what these are all, what these things are there. So the open contract value is the contract value, right? So contract multiple contract size, trade price plus commission and all. So this is the open contract value. Initial margin deposit is the initial margin deposit which is being done with the exchange. That's the contract value multiplied by the initial margin deposit percentage. So there would be a certain percentage that would be for that given trade, and that is how the initial margin is calculated for a particular security or for a particular commodity and all that thing. So market value is contract size, closing market price. So that's the market value. Initial margin variation. So the open contract plus trade date market value, right? So plus open contract value minus trade market value. That's a variation margin. Unrealized profit and loss means the profit and loss that is just reflecting in the trade, but that has not been realized, that has not been utilized. So that is called unrealized profit and loss. So when you take a trade, so there would be a profit or loss that would be shown to you on a daily basis. So that is called unrealized profit and loss, but that has not been realized. That means you have not closed the trade. You are still having a live position in that trade. So that is how it is called unrealized profit and loss. Daily variation margin, previous market value minus the current market value, right? So that's we have already seen. Closing contract value. So again, it is the contracts and the closing price plus minus commission. Final variation margin is the previous market value and the closing contract value. So this is the terms, and realized gain is the open contract value minus the closing contract value. Okay. This is an example. You can relate the same thing that we discussed here with this example here. What is the open contract value? This is the contract value. Okay. 75 is the lot size, and the contract is this. This is the strike price, and then one lot is there. So this is the total. What the initial margin deposit? 8% of this. That is 69,000. Market value. If Nifty closed at 11,300, so accordingly the market value will go down, and it is your 11,300 is the closing price for the lot that you bought. It is a NSE Nifty contract we're talking about here. It's a NSE Nifty contract that has been bought. Direction is buy, and the initial margin 8%, commission is 2 basis point. So initial variation margin is how much initial variation margin happened from difference of 11,500 to 11,300. The difference is of 1,500. If we calculate with the in the valuation in the value, it will come out 15,000 is the initial variation margin from this to this, right? So unrealized profit and loss 15,000 because the same thing is there. Daily variation margin is again 15,000 because if you look at from the yesterday's closing price to today's closing price, the difference is of 15,000 only. The closing contract value. So this detail or this number is calculated basis daily trade value. One day trade value you can say. It's not for the entire month, but for a one day it is shown, and one can calculate for the whole month in a very similar way, right? So realized gain and profit is again the same thing, 15,000. Okay, so now this is to show you the payoff of futures and forward, how the payoff would look like. Payoff is basically it's a linear graph, right? Linear graph means that represent the profit would be there when the movement in the share price is directional, whichever. If it is negative, then there would be a negatives in the payoff, and if it is in the upside movement in the stock, profit would be positive. So this side is representing profit and this side is showing the loss. So if this assume the strike price is 1000, right? As in strike price is 1000. If it moves up, then these are the profit potential and it is unlimited. The profit potential in future and forward both are unlimited, and these are the losses, right? These are the losses represented here. So this is just to give you an understanding how the payoff would be. The payoff in case of future and forward are linear because it is just depending upon the underlying price, it will move up and down. Similarly, for short position, it would be like this. So in if you look at from the long position, it would be going this way. For the short position point of view, it would go this position. So it would be profitable only when it moves down, right? So when the share price moves down, then it would be. And in case of your spot forward and future payoff, if you look like the forward uh, for the forward, largely the price movement wouldn't be huge because the forward are the customized deal, right? So the customized deal don't have that much liquidity. That's the reason it is shown quite static. However, if you look at the future, there is a trend. The trend is shown, it is rising with the spot price moving up, the future price is also moving up. In case of forward price, the forward price is just linear. Why? Because it is not that liquid. However, it doesn't mean the forward price would not be moving. Forward price would be moving, but it is from the liquidity point of view, it is shown there wouldn't be much change in the price value because it is just the trade has been done between two party and not actually happening on an exchange, and therefore the liquidity would not be there, and that's the reason why there would not be huge price movement happening in the forward price. But in a real sense, there is a there is a movement which is due to the underlying assets only. Same is shown in case of the price falling. This is price moving up and this is price moving down. These are the names of the exchange, major future exchanges across the world. Some of them are there, as in the one which are quite prominent and known. Okay. This is exercise here, just to calculate a daily profit and loss, right? So example is given you. You may look at this example and try to figure out what would be daily profit and overall profit and loss, right? So this exercise is for you. There is a buy 15 Nifty Infi, sorry, not Nifty, 15 Infi contract, Infosys contract at a strike of 3000. Okay, lot size is 5. Okay, lot size is 5 and maintenance margin is 20%. Overall contract value how much? 15 multiply by 5 multiply 3, so total value you see is 2,25,000.
Yes.
And maintenance margin is 45,000, which is given here. Initial margin is this is 78,750. These details are already given to you. Now you need to calculate daily profit and loss with the price movement given to you for the stock price. It's simple exercise, nothing fancy here, nothing difficult. And with the price movement, the daily profit and loss you need to calculate. Okay.
Yes, sir.
So with this, we are done with this particular section. Any questions so
Sir,
far before the program?
on this particular slide, there is a towards the left top. It's mentioned 2 BPS. What does that mean?
Where?
So the previous one, the previous slide, not prior to this.
This one?
No. So prior to this as well. Yes, this one.
Yeah.
I am 8%
Okay.
commission to
Yeah,
BPS.
BPS it is called basis point. So 2 BCS is a commission which is as an when you say 2 basis points, so that means point 2 divided by 100.
Okay.
1 basis point is basically one 1/100th, one part of the 100. So 1 divided by 100. So if I say 1 basis point, it is 1 upon 100.
Okay.
So basically, if you earn 100 rupees profit, then 1 basis point will be given as
Yeah,
commission.
that's the commission, right? So it would be
Okay.
calculated. Sorry, it would be calculated on the contract value. So the contract value is 8,62,000, right?
Okay.
So 2 basis point means 2 divided by 100. So that would be the point. It would come out your 0.02, right?
Okay.
0.202 multiplied by this. So that's the contract commission value
Mhm.
on the on this deal by the broker.
Sure, sir.
Yeah.
And in the last assignment part, sir, wherein we were,
Yeah, this one.
yeah, this one,
Yeah. So this is
20% of the maintenance margin. So
yeah.
it
Yeah.
comes to
So this is
159. It's mentioned 78,750 initial
no.
margin.
That is the initial margin. Maintenance margin is this 45,000.
So 45,000 is of 20 of what value, sir? Like over all value is
This
2
this
lakh
this value.
25.
Yeah.
Okay.
It should be this value. What is the amount comes with this calculation?
नहीं
Yeah, 45,000. So it's right.
Right?
It's
Yeah. So
yeah.
this is your total contract value. So 20% this. So it would be 45. Okay, fine. And this is your initial margin, which is given, which you're paying upfront. It's a upfront payment which you're doing to take a position in this deal. You're buying a 15 Infosys contract, and the lot size is 5, which is which is not the real, because in a real sense the Infosys contract is big. It is 600, I guess. I took a position. In a put contract, the option one, not the futures one. So I remember it. I don't remember every stock, but for Infosys it is 600, and for TCS I guess it is 300, and for ICICI I already told you the lot size for one lot is 1375 shares is one lot. But this is just for your just to make your understanding around how the calculation of mark to market or variation margin takes place, right? How the profit and loss is calculated. Profit and loss is also in a real. If you look at the profit and loss, it is a variation margin, right? If I say variation margin, or if I also say profit and loss, it is one and the same thing. You can look at from a different. What is the variation margin term? There are different terms given, but what is varying from a day one to day two is basically showing either a loss or the profit for an individual, right? So just to look at this one, the first we can see in first case it is 3010, right? So what is the profit? Daily profit is 750. Sorry, 750. Yeah, because what was the initial price? 3000 was the price. It moved 10. 10 multiplied by this 10. Sorry. Yeah, so 10 multiplied by 5 multiplied by 3000, right? In fact, you would have to do it this way only. So 310 multiplied by 5 multiplied by 15. So then the difference would be the profit and loss, right? One second. Mhm. Okay. So you see, this is your 3010 dot 5 dot 15. This is the value minus 2250, 750, right? So this is given there, and next day it is 350. 3050 multiply by 5 multiply 15. So this is the value minus 225. This is your overall profit, right? This amount is your overall profit. Daily profit, if you want to calculate daily profit, then you need to minus the 750, because yesterday's profit I would have to exclude, right? Daily profit निकालना है तुझे. So I will minus 750. This is my daily profit. Got it? Any doubt?
Sir,
Uh,
instead
yeah.
of doing it this complex, my multiplying addition minus.
Hmm.
Why
Hmm.
can't we just
Hmm.
multiply the margin over here into 15 into 5? That will be the daily profit and loss, and yesterday's daily P&L we can add to today's daily P&L, and that could be our overall P&L.
Yeah, right. So you're saying with margin we can.
Yes, for example, sir, this is 3,050, and the yesterday's price was 3,010. So margin between them was 40 points. So we could multiply 15 into 5 into 40. That could be the daily P&L.
Right, right. So we can do that.
And
Yeah, good point. Good point. Yeah,
and then
we
adding
can do
it
that.
to yesterday's daily P&L, that will come our overall P&L.
Yeah, right. Yeah, they're right. It makes sense. Makes sense. Well, absolutely. You can just you keep on adding your daily profit, and you can just calculate the overall profit also. Yeah, that is also good. Whichever way is comfortable. But the important thing is the understanding. If you have the understanding, then you can do that way also, and you can do this way also. Ask something based on the individual, whichever is comfortable, better way you find, you can do that way. So for today, so we should be comfortable with the this mark to market thing. So this is basically mark to market you're doing, right? We were talking about is mark to market and all that thing, initial margin, maintain margin. We were doing this one day, the other day in the class also. So this is basically you are doing the same thing, right? Mark to market calculation is being done. So this is how you are actually doing mark to market. Hope everyone is clear with this concept, right? Any
Yes, sir.
confusion or what you can do, maybe if in case there are doubts, you can just go through it today, and tomorrow maybe in the morning we can discuss it for 15-20 minutes and then start the other chapter with the options.
Sure, sir.
ठीक है ना तो ये we can okay. So just give me a second, let me just get my my register as in the diary where I was making comments for the for the mock interview. I'll talk about for 5 minutes. It's a common one, right? Then for individual, I would be talking face to face.
So can you remove the calculator part from that screen?
Okay, 1 second. This one?
Thank you. Yeah, yes.
Okay, no worries. Hmm. Hmm. Okay, so the common feedback which I have because okay, so just to let you know, the most of the questions which I asked in the mock session, mock interview, they were more or less similar in a sense. So it wasn't. Uh, there were few new, otherwise most of them were same. So while I asked to all of you, there might be some tweak in the language or maybe tweak in the statement which I put before you. Otherwise, the questions were largely same. So okay, so I asked about what are the preferred share. So somewhere the feeling which I got is we know we have an understanding about preferred share, but when it comes to the explanation, we were not able to recall all of them quickly. So so this shouldn't happen. While you're talking, you shouldn't fumble. Rather, I would say because these are the things that you've done. So you should be very hands-on and very in control while you're talking about the preferred share. It shouldn't be you're missing out the options or missing out the types of options here. You had an understanding, you knew about the preferred share. Most of you, I would say, were not confident while talking about those four different kind of preferred shares. So that is something which I realize shouldn't happen. Okay, then I talked about the subprime crisis. And the answers which I got around subprime crisis was not the detailed one. I was looking for a detailed explanation. So when I say detailed explanation, so it should start how this subprime crisis started. So it started from 2002, right? And there how the loans were given to the borrowers, and the loan were bad quality loan. How the loans were bad quality, because it were even given to the customers who were not having a good credit rating, right? So this is how you should have started this, and then to build on, some probably talked about securitization also, which was not necessary. Maybe you're adding, that's fine, but not, we should be adding about securitization only once you started about the subprime loans, because the question was more about around the subprime loan. It was not about securitization. Okay, then there was questions. I'm just looking at my book. I'm reading those. Okay, then there was a question of around ADR and GDR. ADR and GDR should have explained in a in bit better, because I ऐसा मुझे लगा कि it was not because you were explaining about only one kind of ADR, not focusing on the unsponsored ADR. Because when I asked about a question, I've twisted a question. Can the ADRs be there without the consent of company? I guess there was some of the confusion I saw in few people's mind. I'm not saying for everyone, but there were few confusion which some of you had. Okay. Okay. आईपीओ प्रोसेस के बारे में मुझे लगा कहीं ना कहीं जो है डिटेलिंग थी वो उतनी अच्छी नहीं थी. आईपी प्रोसेस को जो डिटेलिंग थी वो उतनी अच्छी नहीं थी. Then, okay, there was one simple financial market thing. So when you were talking about the financial market, you probably did not detail much about the features of the financial market. Features in a sense, it has liquidity, it has price discovery, all those things that we discussed. You remember the day one. So those features you need to elaborate. You need to build on your story on those features so that it 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 looks a good explanation about the financial market. What financial market has in its offering. That is what should go very clearly to the interview. Okay. Then what is more? Okay. Okay. Then okay. There was a very general question I asked. So what lesson we learned after this crisis? And I guess it was asked to everyone. So lesson, when I say lesson, so that means you need to elaborate more on the regulation side. So did we have more controls? Maybe you need to name few of the rules, the laws that we talked about, EMI, Dodd-Frank, and all those things. You should have talked about those explanation a bit more. Well, which is okay because हमने इस पर डिटेल में नहीं किया उसको फाइन है, बट यू शुड हैव एटलीस्ट नेम्ड इफ नॉट डिटेल्ड दोस रेगुलेशन, राइट? नेम तो करना ही चाहिए था आपको. दैट्स इट. सो ओवरऑल आई वुड से कि थोड़ा सा और हमें यहाँ से मतलब आई हैड एक्सपेक्टेड बेटर, टू बी ऑनेस्ट. To be very honest, I had expected bit better performance from given uh, the maturity of the class and all that. So I was expecting bit more from every one of you. But nevertheless, there are opportunities, and I would be giving you scores and all later on. I'll sharing those scores later. Okay, so that is it. Any more questions? Anything you want to discuss?
So for tomorrow class, the times and all will be same. And
Yes, it will be same 10 to 1 for tomorrow also.
Okay,
Yeah,
sir.
it will be 10 to 1 only for 3 hours, right? And when it would be class, I guess we can have as in 12 to 4 or maybe 1 to 4 also. Sorry, 1 to 5 or 12:30 to 4:30 because at times it is bit of a hurry in the as in reaching class at times due to certain reasons. So I will see like if we can have 1 to 5 or maybe 12:30 to 4:30 going forward
Sure, sir.
when we start with the classroom sessions, right? Okay. So that's it from my end. Before we close, if you have any question, do let me know. Uh, else let's meet in tomorrow's class morning sharp at 10.
Sure, sir.
Okay. Okay, guys. Bye bye. Take care. See you.
Bye, sir. Bye, everyone. Thank you.
Bye bye, sir.
Bye. Goodbye.